Good afternoon, everyone. We'll go ahead and start. Thank you for joining today's call on the Q1 earnings release for Hela Holdings. So just to give you a quick overview of today's session, we have a short presentation to run through for about 15 minutes, which will cover the key highlights of the quarter, and the outlook going forward for the rest of the year. But before I jump into that, just any questions you have throughout the session, please feel free to put in the Q&A box. We'll also have a Q&A session after the presentation. So feel free, we'll be able to unmute you at that time if you raise your hand as well. But feel free to also put any questions that you may have as we move through the presentation in the Q&A box, and we'll take them up afterwards. Before we jump into the presentation, I'm just going to do a quick round of introductions. So I'm joined today by our Group CEO, Dilanka Jinadasa, our Group CFO, Moiz Ramanji, and our Deputy General Manager of Corporate Finance, Savindia Tessera. Just also to reiterate myself, my name is Adam Collins. I'm the General Manager of Corporate Affairs and Investor Relations for Hela. So now before we jump into the presentation fully, I'm going to hand over to Dilanka to give a short overview of the quarter and the outlook before we move into more detail.
Good afternoon, everyone. Thanks again for joining our second earnings call since listing the entity. So we'll be following the same format that we ran through during the last quarter review as well. And what we will really, as mentioned by Adam, what we will really capture is a recap of the quarter that we just completed, and then also to share our outlook and then from both risks and opportunities, and how we are looking to mitigate the risk and capitalize on the opportunities at hand. At a very high level, when we look at the quarter that we just completed, as you can see on the screen, it was a decent quarter in our opinion. I think while we've had positive results, we do feel that we could have done better in certain aspects of the business. From a revenue standpoint, in rupee terms, of course, we've had a 114% growth year on year, and from a dollar standpoint, it was about a 28% growth that we experienced. This kind of reconfirms the strong position that Hela holds with the customers that we serve. As we mentioned in the previous earnings call, we have a very narrow and deep focus when it comes to servicing customers. So this entire revenue is effectively generated between 10 to 12 customers, where we hold the first, second, or third largest supplier position within those brands. We will also capture in the subsequent slides some of the new brands that we've started relationships with that we are very excited about, because we feel that the growth potential of these brands are quite big, and they will help mitigate some of the risks that we foresee in the subsequent quarters with softening demand coming in from the retail markets that we serve. Some of the challenges that we experienced in the last quarter was really constrained around Sri Lanka at large. The dollar liquidity was a big challenge for us, particularly in the months of April and May, and we've taken many steps to kind of navigate through it, not only just in that quarter, but in the subsequent quarters as well. We'll expand a bit on that during the slides as well. And then, of course, the main focus for us as a business is really around margin improvement. How do we build upon the momentum that we built around top line? How do we have it continue to trickle down towards our bottom line as well, and start moving towards our end goal of becoming a double-digit bottom line business? So, of course, it's a journey of a couple of years, but I think we're quite happy with the progress we've made, and over the next few quarters, we'll hopefully see us build up on the momentum on the bottom line improvement, or the margin improvement initiatives too. So that's really a recap. I mean, we will touch on how these results will affect the subsequent quarters as well, and happy to answer any questions that you may have at the end of the session too.
Perfect. Thank you, Dilanka. So with that, I'll take you through the remainder of the slides. So just to touch in and focus in on the first quarter again. I won't spend too much time on this slide because Dilanka has really given the key messages, but really what we saw was really the continuation of the positive momentum in revenue growth that we've been seeing over the past 12 months, really reflecting the resilient demand conditions in our key market during the quarter, also the positive contribution from the ramp up of our operations in Egypt as well, which is an additional boost. And what you'll see on the chart on the right-hand side, the pie chart, is a comparison of the revenue split by country of manufacture between Q1 of last year, which is the inside pie chart, and Q1 of this year, which is the outside ring of the pie chart. So what you're seeing is that Egypt's contributing 6% of revenue in Q1 compared to nothing when it wasn't there in the previous year. And you're also seeing that the split between Sri Lanka and Africa is remaining fairly stable. That is because we saw fairly strong growth in Sri Lanka during the quarter as well. But we do think kind of over the full year, this will shift a little bit more towards Africa as well, particularly with the scope for further ramp up in Egypt being there as well. So that Egypt in particular being a positive factor in the revenue growth, and as Delanka mentioned, the significant exchange rate depreciation did boost the LKR figures, which I will touch on in a bit more detail on the subsequent slides. In addition, despite the very challenging operating environment, which Delanka mentioned, profitability did improve, and that reflects really the initial stages of the margin improvement strategy that we are deploying this year, and that is within the context of still quite significant external cost pressures during the quarter. So while cotton prices did drop quite sharply in the final months of June, they were more or less close to a decade high for the majority of the quarter. Freight rates still at historically very, very elevated levels. We were also still seeing global supply chain disruptions from the lockdowns in Shanghai and other areas in China. So and that's not to mention the economic conditions in Sri Lanka as well. So overall, a positive performance on the revenue side, profitability also positive, though not necessarily where we would like it to be, partly due to those external pressures. So to put the Q1 performance in a bit more detail, so these two charts show the group revenue in Sri Lankan rupee terms on the left-hand side, and group profit after tax in Sri Lankan rupee terms on the right-hand side. Right, and so what you're seeing is that in rupee terms, there was a very big jump in revenue in the first quarter, and that is partly significantly reflected by the depreciation of the rupee. So compared to Q1 of the last financial year, the exchange rate was by 68% lower, and compared to Q4, it was by 51% lower. That's like also mentioned in US dollar terms, we still saw significant growth in revenue of 28%. Turning to the profit after tax side, so in Q1 we made 354 million rupees PAT, which obviously a significant improvement on the loss in Q4. It's slightly down from the profits made in the second quarter and third quarter of last year, but we would say that the comparison to Q2 and Q3 is probably not the most accurate. It's more accurate to compare it to the previous Q1s, because Q1 is a quarter which is generally most affected by a number of holidays. So particularly in Sri Lanka, we have the Arido holidays, and we see a loss of working days from that, but also a higher degree of labor turnover during that quarter around the holidays as well. So that comes into play. So generally Q1 is not as good a quarter. Certainly better to focus in on that. So what you're seeing, if you look at Q1 of last year, was a very significant increase. Of course, Q1 of the previous year, so FY 2021, was the most COVID affected year, which is why you're seeing a 364 million loss in that regard. Focusing in a little bit more on the Q1 performance itself. So this chart shows the Q1 revenue in US dollar terms. This is a change from the previous slide, which was in Sri Lankan rupees, for each of the most recent first quarter and the previous two first quarters. Right? So, and then we've split the bars in the dark blue region, which is Sri Lanka revenue, and the light blue revenue, which is Africa revenue. And we've also included gross and EBIT margin in the red and yellow lines. So really the key takeaway from this is that if we put this performance in context, we take out the depreciation, we only really focus on the Q1 performance. Really the story is what we've seen is a continuation of significant and steady revenue growth both across Sri Lanka and Africa. and also an improvement in profit margins, right? But the improvement in profit margins is not necessarily as much as we would like it to be between last financial year Q1 and this financial year Q1 for a number of factors, but obviously is definitely a significant improvement from Q1 of FY21, which was April to June 2020. So really the most COVID affected quarter for us there. So not the most fair comparison. So that is the story for Q1. I'm now going to very briefly touch on where we stand with the IPO proceeds. So as of 30th of June, we had fully utilized the IPO proceeds. And that reflects, as many of you will know, subsequent in May, we released a corporate disclosure announcing that we were redirecting the remainder of the IPO proceeds, which at that time was about 2 billion rupees, towards immediate settlement of debt in the company. And that was really to avoid any further exchange losses arising from the depreciation in the rupee against really what are our dollar-denominated debt and investment requirements. So that process is now fully completed. And so we've seen that creating additional space on the balance sheet, particularly for diversification of borrowing through other sources, which I'll touch on the next slide. And just to reiterate, as we mentioned in that corporate disclosure and last quarter, the company remains committed to the IPO objectives that we stated in the prospectus. So that includes an investment in verticality, the investment in our new ERP system, and the planned CapEx. And those will be funded by free cash flow and additional borrowing where necessary. And just to dive in a bit more on those specific IPO objectives. So really, when we look at the balance sheet, the net debt to equity ratio is the ratio that we're really focusing on, and its improvement. That is essentially went from 4 times last year Q1 to 2 times this year Q1, both because of the increase in equity and the debt settlements that had taken place. So that is a significant improvement. And what that is really allowing us to do is supporting us in accessing additional borrowing from multinational financiers in particular, and essentially diversifying from our concentration in Sri Lankan banks, which is particularly important during this period of constrained US dollar liquidity in the local banking system. So that's really the benefit we're looking for there. In terms of the implementation of our ERP system, which is SAP S/4HANA, so the creation of that bespoke system solution is progressing on schedule and is well progressed for implementation. So that is set to go live in the first operational cluster in the business by September, and then group-wide by early next financial year. So that is kind of continuing as planned and has not been impacted in any way from the change in the use of IPO proceeds. And finally, in terms of verticality, we remain committed to seeking opportunities in attractive vertical investments. So while in the IPO prospectus, we were focusing specifically on Sri Lanka, we are broadening that focus globally to look for the best opportunities possible. And that may include a mixture of different kind of deals or collaborations where we seek to gain experience and mitigate risk of entering a new space by doing it jointly with others or doing it in a kind of low capex fashion. So all those initiatives are still ongoing. It's still a key aim of the company going forward. And we'll certainly be updating you on future quarters as we progress on those. And kind of finally to focus in on the outlook. So as Dilanka mentioned, and as we indicated in our Q1 accounts this time, so we are seeing a softening of the exceptional demand conditions that we've seen over the past year. So the key point there is that it's a softening from exceptional conditions, really exceptional demand conditions last year. And also it didn't happen in the first quarter. We're not really seeing it in the second quarter. It's more for the second half of the year. But in terms of what that means for us, we really do expect our revenue still to remain resilient and grow with the contribution coming in from Egypt and our relationships with new customers, which I'll touch on in the next few slides. And as Dilanka mentioned, really that focus on profit margin improvement, really contributing to the bottom line significantly, even if there is more measured revenue growth. In terms of the risks to this outlook, they are significant, right? So we could see a more significant demand slowdown in Europe and the US due to additional spikes in prices. We're also looking at a rising interest rate environment and a tightening of global financial conditions. So it's yet to be seen how much global central banks are going to feel the need to increase their interest rates and how sharply that will be, and thereby causing a more significant downturn in the global economy. Kind of other related factor would be rising inflation and macroeconomic pressures across all our operating countries. So while, I mean, the deterioration in economic conditions in Sri Lanka was exceptional and severe, we are seeing similar types of pressure emerging across all our operating countries. They are not to the same extent, but we are seeing those countries all moving towards IMF programs, all seeing pressure on the foreign exchange reserves. So that is something we were working into our broader risk mitigation, largely and partly how we can take the lessons of what we've learned what we've learned from operating in Sri Lanka through such a period to the other operating countries that we're in, so that we're ready if those risks really do crystallize. Briefly, just to give a very bit more context on the outlook for global demand. Really, the key context I want to take away from this slide is that we are definitely seeing a slowdown, but it is a slowdown from exceptional levels, right? And that has been driven by inflation, as I mentioned, but also there is a shift in spending patterns underway. So while last year we saw really strong growth in spending on goods, because many service activities like travel and eating out still remained restricted, we are seeing that shift back now to where goods spending is growing at a slower rate and services spending is going much faster. So that is also a factor that's ongoing in there as well as a slowdown. And also more generally, we are seeing kind of general rebalancing of economic growth after the post-pandemic boom, which was really supported by very extraordinary government stimulus policies in our key markets. So that's really what I'm trying to reflect in the chart on the right-hand side, which is the real GDP growth rates in the US, Eurozone, and UK. So the dark blue bar showing for 2020, the contractions really caused by the pandemic. The lighter blue bar showing the rebound last year very strongly. And then the gray bar showing the IMF's latest forecast for 2022, which is showing a marked slowdown, but still compared to historical growth rates, it's not too bad. That red dash line I've added on this is the average real GDP growth rate in these countries over the preceding 10 years to the pandemic. So it is kind of in that benchmark. So it's really yet to be seen how exactly extreme or severe the current slowdown becomes. I think the context I'm just trying to drive home here is that it's a slowdown from exceptional levels, not necessarily a collapse in consumer demand. In terms of what we're doing to navigate through it, kind of building on what I said in the previous slides, we are focusing on really strengthening some of the new customer relationships that we established. So one would be Victoria's Secret, which we just made our first shipment, I think this month. Yeah. So that is a brand that we were not working for, which is a huge global brand where we have significant potential to increase our penetration throughout an economic downturn. Even if their overall business is kind of staying at the same level, we can grow significantly within their supplier base. The second kind of pillar to this customer strategy is fast-growing and innovative new brands that will grow really regardless of economic conditions. So the one I put here is Castor, which is a really fast-growing UK-based sports brand, which is working on a lot of interesting sponsorships. So what you're seeing here is also Glasgow Rangers on the left-hand side, Andy Murray in the middle. But also they've recently just signed up with McLaren F1 and also the English and the South African cricket teams, right? So there's a lot of potential for us to grow with them as they, kind of expand really fast into this kind of key sportswear market as well. It's kind of despite the economic conditions. Focusing in more on Hela. So just to give you a bit more context on the margin improvement strategy, that's really going to be, now that if the pressure is coming off slightly from the kind of high degree of revenue growth we saw last year, it's really focusing on strengthening our operational excellence and reduction of waste, right? Kind of consolidating the revenue base that we have and being more efficient on it. As well as that, right, we're obviously seeing reductions in global commodity prices, particularly cotton, as I mentioned earlier, and global freight charges are coming down as well. So we will be capitalizing on those to the extent that that's possible, given in the kind of how much we can pass that on to our customers as well. And thirdly, the rollout of our SAP ERP system in the second half of this year is going to be really crucial in kind of giving additional real-time insights to the business, reducing double work, and really strengthening margins in that manner by reducing and strengthening the efficiency of the business. And finally, the final pillar is really focusing and continuing to focus on improving our customer offering. So the first part of this is really maximizing the benefits of our Egypt footprint. So we continue, despite the kind of darkening outlook for consumer conditions, we are seeing really strong consumer interest from our customers in Egypt. And that includes a range of new customers as well. So how do we, as a kind of early mover into the Egypt space, how do we capitalize on that as much as possible to build some new customer relationships to a significant level? Secondly, would be continuing to acquire additional technical capabilities in more high margin products, particularly lingerie and performance wear. And we will also be continuing to seek new opportunities to strengthen our value proposition. May it be that on product types, country of origins, like looking at how we, throughout kind of a downturn in consumer demand, how we continue to grow by offering brands solutions to the issues that they face. So those are really the three pillars of the strategy that we are following to kind of take us through this slightly uncertain period. That is more or less the end of the presentation. I have included in this presentation a couple of slides on our community empowerment work and also our environmental work. I'm not going to go through these slides in the interest of time, but we will be sending out the presentation deck after the call today. Our annual report was also published on the CSE website yesterday. So that will be available for you guys to download. And that has a lot more detail on both of these areas as well. So that is also a good reference point. But that brings me to the end of the presentation section of today's session. And then we will be opening up for questions. So feel free to drop your questions into the Q&A box. Or if you can raise your hand, we can also unmute you to ask your question as well. We'll just give a couple of minutes for people to send in their questions. Yeah. So one question that's come in, just to jump into it, was how much of the USD revenue growth of 28% was driven by volume growth as opposed to average selling price or product mix improvement? And what was the capacity utilization for the quarter? Dylan, I'll let you take that one.
Sure. So Kushan, as for the volume growth, it was really around the number of units. It's a little hard to just to pinpoint into that because we work on what we call SMVs, standard minute values, and that value changes depending on the product category. But overall, we saw revenue growth coming from, yes, there was the average selling price also increasing, but majority of it coming from volume growth itself. Because if you look at the capacity increase that we've encountered over the last 2 years, we've added over 4,000 new employees into our payroll. So that that capacity generated that additional incremental revenue for us. The capacity utilization was actually above 100% over the last quarter. In fact, not only did we utilize our entire internal capacity, we were also working with some partner factories in Sri Lanka, in Kenya, and also in Tanzania because of the insufficient capacity that we had internally. So we are maintaining that 100% capacity utilization even in extending to the second quarter. And that's as we go through the second half of the year, what we expect is that we will drop the partner capacity, the factories that we're using, and then focus on fulfilling our internal capacity, trying to maintain it at 100%.
Thank you, Dylan. Another question from Rahul. What is your outlook on apparel demand globally with the economic slowdown? will the industry see a drop in consumption or will it bounce back? What regions or product segments do you expect to see a downturn or perform well?
Yeah. So I think Adam touched on it on his presentation as well. It's a combination of factors. One is, over the last 12 to 18 months, we've seen exceptional demand growth. And this was due to pent-up demand, stimulus, categories which Hela was engaged in gaining most of the wallet share because, with travel being restricted or people working from home, the demand for apparel products, even the likes of, suits, denim, all that wallet share was transferred into underwear, loungewear, and activewear. So now with the world moving past COVID and in an environment post lockdowns, that wallet share is now being shared with the other categories as well. And you're also seeing people spending their income on things like travel as well. So there is a lot of competition for us in that particular categories that we serve. So we do see a softness. How long it will go or how long it will take to bounce back, it's too early to tell. Even the retailers are trying to gauge it. Right now, what we think is there's a bit of a knee-jerk reaction because they were expecting the level of demand that we were experiencing over the last 12 months to continue. So we are seeing retailers reporting, 180 to 250 days worth of inventory at the retailer level. So hence why they're trying to course correct a little bit. There are certain markets which are still weathering this downturn a little better than US and Europe. So we are seeing, demand come from Asia. So China, Hong Kong is a market which we are seeing demand actually increase. We're trying to explore India as a market. Egypt is another market that we're currently exploring. So we are not we're not waiting for our traditional markets to pick up. We're exploring new markets to shift to and make sure that capacity fulfillment is at 100%.
Thank you, Tamanka. Now there's a question on the increase in distribution costs in the first quarter. Where's your attention?
So, that cost has gone up. There's been a general increase as well in terms of freight rates compared to the previous quarter, which is 12 months back. But apart from that, even some of the challenges that we had in quarter 4 with one of our key plants, which was in Kenya, there are certain yard freights also that we had to incur to cater to customer expectation in terms of deliveries, which was the biggest chunk that impacted the cost of the distribution as a percentage of the revenue.
Yeah, thank you, Maurice. There's also a couple of questions on kind of how the order book is looking for the next 3 months towards the second half of the year, and whether we're already seeing a slowdown in orders coming from the EU and US. Don't that with you.
Sure. So the order book, if we take the months of August, September, October, it's still quite steady. Only thing is that, like I said, that exceptional growth that we experienced over the last 12 months, that's what's being curtailed. At one point, we were maintaining about 12 to 13 partnered factories because we didn't have sufficient capacity internally. That has right now, I think, reduced to about 3 as we speak, and that will come down to 1 from September onwards. So we still have sufficient demand to fulfill our internal capacities. And the order book for the next, to answer your question, the order book for the next 3 months looks steady enough and it's sufficient enough to fulfill our internal capacities. What happens post November, December, it's little too early to say. I think the retailers themselves are reading the way the retail markets deliver during the holiday season will be a crucial factor as well. So it'll be interesting to see how it works. So I think for us to offset this demand drop, what we need to do is we need to bring on incremental customers, new customers who we didn't have, who we weren't working with before, so that any sales that they bring in will be incremental sales. And although it won't generate towards revenue growth for the group, it will help offset the demand drop that we experience from our core customers.
Thanks, Duncan. There was a question on the top 5 customers of Hela in the first quarter of this financial year. So we're not disclosing that information on a quarterly basis, but I would say that it remains very much more or less the distribution which was shared in the IPO perspectives in terms of customer mix, with the big headers being brands such as Family and Tommy Hilfiger, Tesco. and being among the top 5. A few other questions. So a couple of questions on the industry. Do you believe that the Sri Lankan apparel manufacturer would be able to break away demand from major players such as Bangladesh and Vietnam by being price competitive with the drop in cotton prices and the rupee depreciation? If yes, to what extent do you speculate?
Right. So I think the drop in cotton prices benefits every country since everybody sources from the same regions. But as far as cost of operates from Sri Lanka is concerned in dollar terms, yes, Sri Lanka is, especially the salary base, is quite competitive even compared to a Bangladesh. I mean, a 30,000 rupee basic is effectively like $82 compared to a Bangladesh's $110 salary. But that said, as you know, inflation here is north of 50%, food inflation is north of 90%. So we've had to, what the rupee depreciation has allowed us is to absorb some of these hits, some of these inflationary pressures. And, we've had to pass on some of the benefits over to our employees to help, navigate through the personal challenges they may be facing through. And also the local overhead, the rupee overhead component has also shrunk considerably. All the fuel for transport is bought in dollars. Our generators are run using diesel that we procure in dollars. A lot of our suppliers who were buying in rupees have shifted to dollars. So that benefit that we were getting has also decreased over time. And also, if you saw in the earlier slides, only 51% of our revenue is coming from Sri Lanka. So we don't get, even though we did a $70+ million turnover, we get the rupee benefit only for less than 35 million of that revenue. And the rupee component of that 35 is also quite small, shrinking anywhere between 20 to 25% of that. So it's a little room. Yes, you do have a benefit, but I think what this has done is, like I said, it has allowed us to absorb some of these inflation pressures and pass on some of the benefits to our employees and also certain suppliers too. Okay,
thank you, Delanka. There is one question on whether Hela benefits from the GSP Plus concessions in exports to the EU. The straightforward answer to that is yes. That is a key benefit that we always seek to offer to our customers when manufacturing in Sri Lanka. And so we benefit both to the EU and to the UK as well, including under its new scheme, which was announced yesterday. Okay, in terms of other questions, so a question on Egypt. Question on whether Egypt is profitable now and how long do you expect it will take to make profits?
Yeah. So Egypt is profitable for us right now from a year-to-date basis. It is the fastest plant that we have turned around from greenfield to profitability. And I think the advantage we've experienced with Egypt, even though Egypt has a $2 billion industry, it's missing many global players. So the benefit we've had from that is the first move advantage, and it's helped us to onboard customers which we couldn't have onboarded if we didn't have Egypt in our portfolio. So, Victoria's Secret is a prime example. We've been attempting to onboard Victoria's Secret for over 6 years now. And I think one of the main reasons that they onboarded us was because of the presence that we have in Egypt. There's a few other customers in our pipeline, global sportswear brands who've been looking to onboard. But now that they've entered Egypt, and when they enter a country, they want critical mass. So that allows us to get into their supply mix as well. So Egypt has met our expectations, and we expect it to contribute to our bottom line in the subsequent quarters as well.
Okay. A couple of questions on the outlook, which kind of reiterates some of the previous points, would be what bottlenecks or challenges do you see for the industry in the next 12 months? Yeah. Whether you expect a slowdown in both more luxury brands such as Calvin Klein and Tommy Hilfiger, as well as value brands such as Warner's, Asda, and Tesco.
Right. So as far as the bottlenecks for Sri Lanka is concerned, it's really the narrative. It's a constant battle that we have with our customers on convincing them on the stability of the country. Because, with the pie effectively shrinking, brands are picking and choosing as to which countries and which suppliers they want to share this pie that's much smaller. So it takes a lot more effort to convince them as to why it should come to Sri Lanka. So that's always been a constraint that the industry, not just Hela, that the industry has faced over the past few months, but with things stabilizing now, the brands are getting that assurance, because what the industry has also managed to do was to deliver despite the challenges that the country faced. And you saw that with record exports being recorded last month out of Sri Lanka. I think it's north of $500 million for the month. So yes, it's a bottleneck, but it's a bottleneck that we think we can manage. Although the return on effort is the question. Whether we expect a slowdown across luxury brands and value brands, it's again too early to say, but we are seeing that softness across the portfolio. I think there are certain brands, Adam touched on Castor, where we are seeing them being a lot more resilient than some of the other brands. But whether you take a Asda or Tesco or a Calvin Klein or a Michael Kors, we are seeing that softness coming in. Whether it's a knee-jerk reaction, over precautionary measure from the brand side, it's too soon to say. But we are seeing that impact across the board, because even if you take a Asda or a Tesco, what we're seeing is that you're seeing 9 to 10% inflation in the UK. So the real disposable income our consumers have also shrunk. So that particular wallet share that they share between fuel, food, and clothing, that's the piece that they're really fighting for. And food and fuel taking priority, and then whatever's left coming towards the better piece. So that's another challenge that we're having. So
Okay, thank you very much. Damanka, I think we'll be finishing up in the next few minutes. So if there's any final questions, please do send them in. It's just one final question that we have is whether we're experiencing any pressure to reduce prices, and if so, to what extent?
We are seeing pressure. More than pressure to reduce prices, we are seeing pressure to not pass on inflationary pressures back to the retailer. So we've been forced to almost absorb that inflationary pressure. But with demand softening, again, Adam touched on it as well, cotton prices are coming down, freight prices are stabilizing or even coming down. So what we've been able to do is to negotiate better with our supply chain partners to capitalize on their potential open capacity situations as well. Gain that, keep some for ourselves also to have those margin improvements, but then also most of all pass on as much benefit as we can to the retailer so that they can retail it at the best price point possible and boost their sales, which in turn benefits us through increased order book allocation. So
sure. One final question before we come to close is, can you give a bit more color regarding the fabric mill? And if that is to come online, how much of the fabric requirement will that provide for Hela?
So we are still very, very keen on having verticality. I think COVID taught us that supply chain security is one of the most critical factors, for especially when it comes to business continuity. It's just that the fabric mill which we were targeting was based in Sri Lanka, and we lost on that opportunity. And now what we are looking at is Sri Lanka the place that we should be investing and building this capability, or should we be taking that to Africa where we see future growth potential? So there are a few target firms that we've identified, but it's still at a very early stage. Once we have some further stability in the country, into our liquidity positions, then we will look at exploring this a bit more aggressively. But we've got the full intention to have verticality added, hopefully towards the end of this financial year or sometime within the next financial year.
Yeah, I think I just re-emphasize that our annual report kind of gives a lot more detail on our whole supply chain management strategy, including kind of the distribution globally. I think in last financial year we hit 30% of our African sourcing coming out of the African continent itself, and we'll be looking to increase that to 50% this year with a combination of existing suppliers and other partnerships that we could establish. Okay, one final question before we close the meeting is on whether the finance cost of 674 million recorded for the quarter includes any forex losses, and is this arising from any rupee-denominated assets held by the group?
There were some forex losses during the quarter, but we had managed to mitigate it quite a bit because this arose mainly from the IPO rupee funds that got carried forward into this financial year as well from the previous financial year. But as you all know, even in the last financial year, we were able to adopt strategies to fast expend those LKR fund reserves that we had from the IPO. And hence what got carried forward in the current financial year was quickly used up in the months of April and May itself. So there was an impact, but it was significantly less than what it was for the Q4 of the previous financial year.
Thank you, Maurice. So I think we've covered more or less all the questions that we had. If we've missed anything, please feel free to drop an email to us. We'll definitely get back to the investors@helaproling.com email address. As I mentioned earlier, we will also be sharing this presentation with you shortly after we finish today. So yeah, please feel free to reach out if you do have any further questions, and thank you very much for joining today's call.